Hello, ladies and gentlemen. We are Group 2 from Foreign Trade University in Hanoi campus. Today, we are going to propose our buy recommendation for MBB, Military Commercial Joint Bank with a target price of 28,383 at the end of 2020, upside 37% compared to the valuation date on 6th of March 2020. The target price is calculated based on the PNB comparative valuation method and residual income valuation model by weighting up 30% and 70% respectively. Our investment view is based on the perspective of the banking industry, of the competitive positioning of the MBB, and its healthy financial status as well. We will go over the investment view, go to industry in an overview and company in details, and we will moving on to the financial analysis and valuation, and wrapping up with investment risk. First, we'll go with the business description. Military Commercial Joint Bank was established in 1994 and listed on Ho Chi Minh Stock Exchange in 2011. By the end of 2019, the total asset of MBB reached 4,011 trillion, ranking fifth in the banking system, with the ratio of equity to total asset is 9.7%. Currently, MBB has over 300 head office, branches, and transaction office, and MBB owns a diversified subsidiary system in many areas: insurance, financial service, asset management, helping to diversify products beside traditional banking system. Many subsidiaries of MBB such as MB, AMC, MBS, MB Cap, MB Cincy, MIC, and MB Ages. And income of traditional commercial banks consists of net interest income and net interest income, non-interest income, with a trend of restructuring to non-interest income activities. This is a general trend of the banking industry, as this segment has a higher profit margin than net interest income and is less dependent on the interest rates instability. And we can look at the loan structure. It can be seen that MBB is tending to shift strongly to the retail segment, balancing the ratio between businesses and individuals. And about the shareholder structure, by the end of 2019, the largest shareholder of MBB was the Viettel military industry and telecommunications group with 341,000 shares, equivalent to a 14.63% ownership. This is followed by the State Capital Investment Corporation with approximately 10% ownership. Joint Stock Commercial Bank for Foreign Trade of Vietnam is also one of the strategic shareholders, holding for approximately 5% of the shares. Currently, MBB has adjusted the foreign room rate from 20.9% to 22.99% since March 10, 2020. Foreign shareholders of MBB, including big names such as North Bank, Sham Industry, Vietnam Enterprise Investment. Experienced management team has been with MBB for a long time and used to hold important positions of big companies and corporations. Military Bank has developed three strategic pillars: community bank, professional banking by industry, digital banking, and two strategic platforms: superior risk management, fast execution capacity, focusing on four key shifts: digital banking shift, improvement customer relations, exceptional risk management, improving member company performance. Moving on to the industry overview, we can see that our first argument is Vietnam's macroeconomics is forecasted to continue growing steadily to support the development of the banking industry. In 2020, Vietnam's economy will slow down slightly, but will remain high compared to the region and the world. GDP growth is forecast at 6.5% of the main distribution from personal consumption and FDI. System liquidity is forecasted to be stable thanks to growth in exports, state budget surplus, and high foreign exchange reserves. Moreover, lower lending rates, deposit pressure, and restructured loans to the SMEs and individual segment will help improving the NIM as the net interest margin. As the economy slows down, GDP growth slows down, and demand for long-term loans for production and business decrease. Credit demand is forecast to slow down as well. Banks lacking capital will be limited credit extension like CTG and Agribank. And in terms of credit supply, the LDR ratio is extended for most banks except for the state bank, which help reduce deposit interest rate pressure and also improve the profitability. Customer deposit is expected to grow at the 11.4% thanks to the increase in the LDR ceiling to 85% for Joint commercial banks. In addition, the number of SMEs currently accounting for 97% of the total enterprise in the market show that the great potential of loan demand for this group of business. It is estimated that the net interest margin of the total industry will grow slightly to 3.64% for listed businesses, as you can see in our charts. Moreover, the non-interest income continues to increase the proportion of total operation income structure. It will be promoted by the exploitation of bancassurance services. Non-interest income now accounts for 24.6% of the operating income structure of the bank system, thanks to the impressive growth of 30% service fee collection and the recovery of non-performing loans, bonds trading, and foreign exchange by 22%. Industry is expected to grow at a high rate of about 20 to 25% in 2020 as banks accelerate to collect fees from payment service. Bancassurance is potential because of only 25% of insurance revenue, much lower than Asian countries, and the number of Vietnamese people with life insurance is only about 8% according to the collected data. Some banks are expected to record large amounts from one-time bancassurance fee collection, such as VCB and TPB. And our fourth core argument is banks continue to raise capital to meet Basel II capital standards. Banks will increase capital from two sources through paying stock dividends or issuing additional capital to foreign shareholders, or issuing bonds to raise Tier 2 capital. The State Bank of Vietnam currently has CAR at about 9 to 10% of Basel I, lower than 12% at commercial banks, and it is in higher demand for raising capital to guarantee the growth rate. Currently, CAR Basel I of the whole industry is at 11.5%. Financial leverage of banks has also decreased significantly, indicating that banks are also focusing on safer and sustainable growth in the coming periods. Last but not least, improved asset quality has reduced provisioning expense. Currently, banks focuses on dealing with debts from the past. Some banks have been able to handle bad debts such as CTG, VPB, STB did write off many VMCs and non-conforming bank in the balance sheet. The data saw a sharp decrease in provisional expense at banks such as ACB and TCB to support profit. In the coming time, the provision expand is expected to reduce the proportion in total operating income. Moving on to our MBB, our competitive positioning. First, net interest income continues to contribute significantly to MBB's total income. Non-net interest ratio in total operating income structure recorded an impressive growth rate from 60% in 2015 to 27% in 2019, according to our analysis. The diversification of non-interest income sources helped MBB reduce its dependence on the main source of income from credit revenue. Income from payment services and insurance contributes 85% of net fee income. Second, the high yield of assets and low capital costs will help improve the net interest income. The leading cash ratio helps MBB to have the advantage of the mobilization cost. Consolidated credit growth of the whole bank grew by 80.7%, of which customer loans increased by 60.6% and corporate bonds increased by 71%. Meanwhile, MBB's cash ratio was at 33.86% at the end of 2019, being the top bank in the banking industry. The interest rate of deposit remained low, helping the net interest margin's net income ratio of MBB reach about 4.79% in 2019. This is due to the fact that MBB takes advantage of a large number of military organizations such as Viettel, Tân Cảng Saigon, Corporation 336, Corporation 319, and on the other hand, the higher the cash rate, the more the bank value set in the retail banking strategy. Most of the defense spending from businesses to individuals is done through MBB, which brings a large source of demand deposits to the bank. In addition, restructuring to the retail banking segment focused on the individuals and SMEs with high profit margins helped MBB improve lending rates. The structure of individual customer loans on total outstanding loans increased significantly from 26% in 2015 to 42% in 2019. Therefore, MBB has increased its net interest margin rank among listed banks from the third position after VP Bank and TC Bank to second place after VP Bank. Moreover, affirming the effective risk management capacity of the MBB. We can see that the CAR ratio, according to Circular 36 and Basel II, all of this MBB will meet all the Basel II standards. It's about always above the 10%. And by the safe asset quality, the NPL ratio is under stable control. We can see that asset quality is maintained. We note that MBB wrote off 1.8 thousand billion in the fourth quarter of 2019, of which 1,400 billion from the parent bank and 468 billion from MBC. This has been foreseen that since MBB began pursuing a higher NIM strategy. However, the bank was able to generate enough income to maintain asset quality at a really good level. Expressed by 2 points, the provision rate remained relatively high at the 110.5%, the fourth listed among the bank, and although NPL ratio increased compared to 2018, 2018, and provision expense increased by 61%. MBB still maintained good profit. We can see that it also had the stable liquidity. Liquidity ratio also remained at a really high position. Moreover, MBB also showed the ability to manage operating costs effectively. MBB focused on the increasing efficiency in 2019. It can be seen that they do not prioritizing opening new branches and transaction points or increasing the number of employees. The total number of branches only ended up from 300 to 301, and the total number of employees decreased slightly. As a result, operating expenses decreased by -4.9% in the fourth quarter of the 2019 and increased by 11.3% for the whole year. Cost to income ratio has dropped to 39% in 2019 from 45% in 2018, a really significant reduction. And this is our evaluation method. Our group made a buy recommendation for MBB with a target price of 28,383, upside of 37%. And it's based on two methods. The first one is residual income method. The pricing model is divided into two phases. The first phase is from 2020 to 2024. The second period from 2024 onwards with annual rate of 2% per year. Based on the residual income method, the target price is determined to be 25,519. And with the P&B method, for the companies with most access of high liquidity, such as banks, the book value will clearly reflect the net asset value. Therefore, P&B is very suitable for evaluating and comparing banks in the same industry with the MB Bank. Currently, in Vietnam, there are more than 20 commercial banks operating. To select banks to compare with MBB, the group is based on the following criteria. The first one is domestic banks are currently focusing on the retail banking segment. The second one is having a capital structure equivalent to MBB and have a positive EPS, earning per share. And third argument is having major activities in the Vietnamese market. And the last one is most participating in applying Basel II in operation. In addition, the group decided to exclude Vietcombank because Vietcombank was not suitable to be included in the comparison list, explaining that the market often appreciated the leading bank, leading to the Vietcombank's P2B in an area that was always much higher compared to the rest. The inclusion of Vietcombank in comparison group will skew the average values. P2B price to book value for MBB is equal to 1.45 based on the following reason. The first one is MBB has high profitability capacity compared to industry. The second one is MBB is the third banking system of Vietnamese banks that meet the criteria of Basel II. And the last one is diversified ecosystem revenue from subsidiaries. And according to the valuation using the P&B method, we have the price of 29,611. And we will have the investment risk. There are several aspects to consider when investing in the equity of a bank, especially MBB. Normally, in terms of risk of the bank, credit risk and operation risk are very important to understand the operation of bank in the market. The following aspects separate different types of risk. First one, we have the macro risk. Vietnam economy after the period of continuous growth from 2013 to now is expected to grow slowly or even fall into crisis in the near future due to the impact of the downward trend of the world economy. Besides influence of a number of factors such as the COVID-19 epidemic caused stock price to plummet recently, which also significantly affected the banking industry. However, strong financial potential and a large partner system will help MBB limit risk in the coming periods. The second one is the credit risk. The strong shift to the retail segment with home and car loans and especially unsecured consumer credit will increase the risk of bad debts of MBB. However, banks are always cautious in managing bad debts, so the influence arising from this segment will be minimized in the case of the deteriorating economy. The third one is market risk. In market risk, we have interest rate fluctuations and currency risk. In the interest rate, we have MBB's operations are exposed to interest rate risk when deposits and loans are due at the different times with different values. Some assets have no specific maturity and are very sensitive to interest rates and do not correspond to the specific liabilities. The bank stabilized interest rates by setting a new requirements of the Basel Committee. Interest rates will change over time, but with new requirements, it can be kept in a small range. And about currency risk, the risk that the value of the financial instrument will fluctuate is due to the exchange rate of fluctuations. MBB has set limits on positions for each currency based on the MBB internal risk assessment system and State Bank of Vietnam regulation. The fourth risk that we will face the liquidity risk. Liquidity risk, according to the Circular 16/2018, banks are required to ensure short-term loan ratio for medium and long-term loans does not exceed 40%. This policy creates the need to increase long-term capital from customer deposits of banks. This ratio in MBB is still considered to be safe at 33% in 2019. It can be seen that MBB's short-term capital structure is quite solid, while other banks have this ratio fluctuated more strongly. MBank also encountered the operational risk. In the IT system risk, MBB focused on using infrastructure to promote the deployment of pre-security layers. This system that the bank uses are BPM, PD, and DHWH. And about the process risk, data loss or network attacks are a common problem that banks must deal with. MBB tries to avoid these by using modern IT infrastructure. Last but not least is the competitive risk. Fintech's rapid and strong development in the world and in Vietnam in recent years has been able to compete with the traditional banking model. E-wallets, products, and payment gateways investors such as Momo, AppPay, VNPay are increasingly attracting more users. This promotes the digital transformation engine and technology cooperation of the banking industry. Starting in 2019, MBB has implemented many transformation and upgrading projects of modern IT system banking app aiming to target 5 million users of digital banking by 2021. And for this reason, we will have our conclusion. We propose a buy recommendation for the MBB Military Commercial Joint Stock Bank with a target price of 28,383 at the end of 2020, upside 37% compared to the valuation date on the 6th March of 2020. We hope that thank you for listening, and we hope that the investor may have a better analysis and better overview about MBB through our analysis. And we are really hope that investor will have a better health this time and have made a lot of better decisions in this hard situation circumstance.